Good morning and welcome back to Almus Market Mornings. My name is Eshan Naik and today joining me I have Mr. Jayaram Krishnamurthy. The RBI decided to make our mornings really busy yesterday by intervening in the market by approximately 1.2% on the downside after USD INR had touched 91 its previous day. This dip was quickly bought back by importers, post which the prices stabilized for the rest of the day. And in terms of the agenda today, we have the Bank of England and the ECB interest rate decisions, along with the US inflation and jobless claims data, which, as we have also previously discussed, are the two most important factors for the Fed to consider for their future interest rate paths and can simultaneously help us with the trend of the precious metals right now. Good morning, JK. What are your expectations from the data today and its impact on the markets? And also your quick thoughts on whether we can see the 91 big figure soon enough.
Good morning, Ishan. Yeah, I think rupee is grabbing more attention from at least the Indian perspective, uh, while the global markets are kind of winding down. While there are some events still ahead for the next couple of days, I think mostly the reactions from the market show that the players are not there much. Yeah, let's get going with the rupee. We got some help from the central bank yesterday as they stepped in with intervention at a time when the market was overwhelmingly biased towards a further fall during the day. Sentiment and speculative positioning had become extremely one-sided. So the impact of their action right at the open and when the market was trading at an all-time high of 91.05 was significant, as within minutes the spot rate fell below 90. Although, as you said, it recovered to 90.40 later and stabilized there. Obviously, the lower levels was an opportunity for importers who did not let it go, and a good number of hedges were taken. Now, neither the up move from 90 to 91 within a few sessions or the yesterday's fall were with any fundamental triggers or news, while the rate weakened with a little supply but excess demand, that is from 90 to 91. In fact, from around 89.50 to 91 was seen within a fortnight. Uh, all driven by little supply but excess demand. Some speculators positioning themselves long on perception that RBI was constrained to intervene due to depleting reserves was behind the move. And everyone was looking only one way, and it was time for RBI to act with good effect. And once we have a large move, the long liquidation by players itself takes care of the market. That's what happened yesterday. Uh, how do I see going forward? I see the action by RBI only as a stabilizing action. Does not indicate to me that we have seen the top, not as per the unchanged drivers of weakness nor the technicals. I feel it was a cooling action that was needed with probably the use of less reserves and getting more effect due to the market positioning and also thinness of the market. We have to reiterate that notwithstanding the strong domestic fundamentals, exchange rate market in India remains exposed to a big mismatch between demand and supply, and hence the use of reserves by RBI will continue to be in a judicious way and occur at extreme situations. So this means it is still prudent for importers to take advantage of the dips for hedging. And to answer your question, whether it will touch 91, very likely, because there's nothing that happened for us to think that rupee will be appreciating from these levels, and nothing makes me feel that RBI will continue to use much more reserves, in the current uncertain environment. So 91 can be seen. For me, a level where 92 is more important, where natural reversal can take place because the technicals are getting a bit overstretched, and market might feel the risk reward better, in buying the rupee. But also, we need to see some convergence of fundamental positives before that can happen. But a break above 92 will not be good, and that can even trigger much steeper fall. So keep an eye open around those levels. But currently, at these levels, I would still think that some more buying or weakness in the rupee is very much on the cards. Yes, we have the last bout of big events in this week. We have the central bank meetings in Europe and UK. ECB is not likely to change the rates, but UK is very much on the cards to cut rate by 0.25%. The market is actually 100%, discounted rate cut by them today. And even looking at some more rate cuts, looking at the way the CPI came much lower yesterday. So I think that has been the trigger point for more rate cuts to be expected from UK Central Bank, and that has also resulted in some weakness in the pound. ECB, of course, has already indicated that they are in a good place where inflation is actually in the target and continues to be in the target. And probably what people will be looking forward to is how the European economy performs going forward, particularly the major players like Germany and France, with their own inherent problems. Whether they will put up a better performance next year remains key for Europe. Now, interesting central bank will be Japan, where there's so much of discussions have happened whether they will hike or not hike, and particularly the doubts came after the new Prime Minister Tekachi was chosen. Uh, However, going by the recent statements from Ueda as well as the data on inflation and other indicators, the market is now convinced that they are going to hike a rate on 19th, that is tomorrow. However, most importantly, how their post decision sound is important for future guidance. So any indications that they will remain hawkish will not be good for the asset markets, because then it can result in unwind of carry trade against the yen. Already we are seeing the yields on the 10-year JGBs closing in on the 2% mark. It's almost at 1.98%, the highest. So we need to see. There could be some warnings from the Bank of Japan about their plans to curb the yields rising beyond these levels. But then, since they hold a lot of JGBs already, a major portion of the JGBs already, I think again the market would be looking to see the vulnerability in this regard. A breakthrough 2% in JGB yields of 10-year can not be good for the global bond market. It can actually impact the other markets as well. What to look forward tonight will be the consumer price index from US. We last had the number for September only. Now today they will be releasing the number for October and November as well. The market is expecting 0.3% month-on-month increase in the headline and core. Annual number is expected to be around 3 to 3.1%, and that means inflation is kind of remaining at those levels, which is well away from their targeted levels. So that's what is actually balancing the need for rate cuts, as indicated by the weak employment data. So even some of the Fed members, you can see that some of them are focusing on the inflation, which is not falling, so they don't want the rate cuts to happen. Some of them are focusing on the depreciating or the depleting unemployment employment situation. Yesterday's or rather day for yesterday's unemployment rate was at 4.6%, well above the 4.4% seen the previous month. Although the shutdowns could have affected that number, overall the job market in US is not looking good. So the debate will go on. Depends on many factors, because the house is also well divided. So the rate decisions can go either way. Views can remain volatile. And of course, the important factor will also be going into the year 2026, who will replace Powell on the chair. So a lot of things for the market to now actually look and digest. So we will keep digesting these numbers and data, as well as the views from the officials. But market reactions could be limited. We have another hardly 10 trading days in this year. So look for less action, but more, uh, news coming out, which can be just, digested for turning into action next year. One important event that, could grab more attention is the planned meeting between the US and Russia on the Ukraine war in Miami this weekend, because a lot of, talks and discussions have been going on about this particular peace agreement. So we'll see if anything arises from this. That will be something big for the market. Thank you.
Thank you, JK. And just to summarize, the excess demand in the dollar, which we've seen over the last 2 weeks, took prices from 89.50 to 91. And it was just about time for them to intervene as the central bank helped us yesterday because the sentiment and the speculative positions were just one-sided. So to mitigate that, they intervene in the market. But that being said, it's very likely to see the 91 figure again as we have no reasons for a rupee appreciation currently, and the RBI would not be continuing to use their reserves to intervene in the markets. On the global side, the ECB seem to be in a good place with the inflation being on target and not likely to change their rates this meeting today. Whereas the Bank of England is looking to cut 0.25% of their interest rates as the markets have already discounted this. And also the Bank of Japan meeting we have tomorrow are expected to hike their rates, and any sound of being hawkish would not be a good signal for the asset markets as the carry trades would likely be impacted with regards to this. And to look out for, we have the CPI data today from the US, and the October and November data would be releasing today, which we have to look out for. And also, this weekend, we have an important planned meeting with the US and the Russia government between Trump and Putin in Miami. And this is with regards to the Ukraine war peace agreement. So, it will important to see whether anything can come out from this meeting. Thank you all for listening, and we'll catch up tomorrow with a fresh round of updates.